How's it going, guys? If you're new to my channel, welcome. My name is Nick, and before I get into this video, I just wanted to acknowledge that this is a controversial topic, and if you do have any opinions on this, please watch until the end of the video before you comment. I would much appreciate that. So you've probably heard of mutual funds through your family and friends that it's kind of the go-to way for investing, but what exactly is a mutual fund? Basically, your bank will offer you a service whereby a professional portfolio manager will invest your money for you into a diversified group of stocks, bonds, or even sometimes commodities, and really it doesn't require too much work on your part. I'm about to explain to you why it's not the best idea to invest in mutual funds in the long run, because it can actually harm your returns. But at the end of the video, I'll actually be giving you an excellent alternative to mutual funds that I personally choose to invest my money in. So if you do enjoy this video, just make sure to smash that thumbs up button and subscribe down below. It really does help out my channel in the long run. And without further ado, let's jump into the reasons why you should not invest in mutual funds. Now, before you go ahead and invest in mutual funds, just consider the fact that they significantly underperform the market in the long run. Investors will often use the market or the S&P 500 as kind of a benchmark for their investing returns, and this is because they know that this is the return that they can get if they invest in an index fund that mirrors the general market performance. And by this standard, mutual funds have often underperformed the market, even though they have professional managers that try and always beat the market. In fact, a recent CNBC article published in May of 2019 revealed how the majority of active fund managers underperformed the S&P 500 for the 9th year in a row, which came to a total of 64.5% of mutual funds in 2018 alone. So this means that the majority of investors would have made more money just by simply buying an index fund that mirrors the general market performance rather than buying a mutual fund. Furthermore, the article states that over 10 years, 85% of large cap funds underperform the S&P 500, and over 15 years, nearly 92% of these underperformed. So basically, the longer the time span, the more these mutual funds are found to underperform the market. And in order to simply beat the market, you'd have to be among the top 8% of mutual funds, which is nearly impossible to pick in advance. Now you might be thinking, well, Nick, you totally forgot about all of the small and mid cap funds. You only talked about large caps underperforming. Mid to small cap simply means that they're managing less than $10 billion worth of assets. However, CNBC also talked about this, and over a 10-year period, these mid and small cap funds actually underperformed even worse than the large cap funds. So clearly, over the long term, it really doesn't matter which type of fund you choose. It's very unlikely that you're going to end up beating the market performance over the long term. But you might be wondering, what exactly is the reason behind this underperformance? Honestly, there are too many factors to get into in this video, but the number one main reason is because these professional fund managers are actually not in control of the money that they manage. Only the people that put their money into these funds are in control of their money. And since these mutual fund institutions hold so much money from so many people, whenever they make a buy or sell purchase, they're actually going to drive the market up or down. And as you can imagine, in recessions, this would cause absolute mayhem with everyone selling out of the market. When everyone sells out of their mutual funds, this will cause the market to drop, and the ones that still stay into their mutual funds will actually have to suffer all of these losses. So that's just something you should be aware of if you do choose to buy mutual funds. Alright, now on to the second and absolute most important reason why you should not invest in mutual funds, and that is because of the high fees. So I found this one article online from Advisor's Edge, and it simply said that mutual funds cost investors more than $300,000 in a lifetime, while the average balance of an investor's account is only $229,000. This is absolutely insane, and the problem is 100% caused by the mutual fund management fees. Morningstar data actually found that the average mutual fund equity management expense ratio, or MER, is actually 2.35% per year. So imagine if you had $100,000 you had to invest in a mutual fund. By the end of that first year, assuming that the price doesn't change too much in your account, you would have to pay $2,350. And this is just to have your money invested. Now, of course, you can find mutual funds with cheaper fees than 2.35%, but typically all around North America, you're going to find that mutual funds charge between 1% and 3% just in management fees. And for example, it doesn't even matter if the fund managers made you a 10% return that year or you lost 10% in your investments, you're still going to have to pay those fees anyways. In other words, the fees are independent of performance. And it's truly unfortunate because most people don't even realize that there are fees, because these fees are deducted from your returns before you can even realize that they existed in the first place. It's only years later that people notice these fees and the negative impact that it's had on their portfolio over their entire lifetime. Alright, so last but not least, the third reason you might not want to invest in a mutual fund is because you'll have to continuously do your own research. Unlike an index fund or an ETF that probably won't change much in your lifetime, mutual funds are actively managed and they definitely will change over time. You might initially buy into a mutual fund because it has a world-renowned portfolio manager that's really known for making great investing decisions and has a really good track record too, but all of a sudden the manager of this fund could leave and be replaced by some other guy that probably doesn't have as good of a track record or experience, or even investing style. And this can definitely have an impact on your returns over the long term. Furthermore, mutual funds generally have a type of investing style that they follow, whether it be value or growth or whatever, and this can drift over time. And so without you doing research and being actively involved in your managed funds, you might not realize that, for example, your fund could change from a value investing style to more of a growth investing style with the tech boom happening. You never really know. Additionally, fund mergers can happen quite regularly, or some funds could be bought by others, and this can really shift the entire investing style of the original fund. And so when this type of shift happens, it can introduce more risk into your portfolio than you originally hoped for. So guys, the point here is simply that you need to research your mutual fund just so that you know that the story isn't changing over the period of time that you've owned the fund. Alright, so what exactly do I think of mutual funds? Do I own any? And what exactly is the alternative to mutual funds? Personally, the only reason that I would invest in mutual funds is if I had an option through an employer-sponsored retirement program, and this would have very low fees associated with it. Otherwise, for all of the reasons that I just discussed, I would personally choose something other than mutual funds to invest in. For most investors, as well as myself, the best option would be to purchase a low-fee index fund or ETF that mirrors the general market performance, and this can be purchased through Vanguard. This way you can be absolutely sure to achieve that overall market performance, and you'll be paying much less than 1% in fees. For example, Vanguard provides an ETF that closely tracks the performance of the S&P 500, and it has the ticker symbol VOO. And as of April 26th, 2019, this ETF actually only has a management expense ratio of 0.03%. That's basically negligible in the long run. Overall, guys, this would be your best option for a portfolio if you want a diversified portfolio, as well as average market returns and no fees getting in the way. Anyways, thank you guys for watching. I really appreciate it. If you did enjoy or gained any value from this video, just smash that thumbs up button. I would much appreciate it. And if you haven't already, you'll definitely want to subscribe for more content on personal finance, business, and investing. Until next time.